You are listening to a special episode of Value Added, a podcast by Polityka Insight. I am Hanna Cichy, head of business desk at Polityka Insight. This is an episode recorded in cooperation with Citi Handlowy on the occasion of Warsaw Macro Conference. In this episode, we'll discuss Donald Trump's second-term economic policy in detail, thanks to our American guests from Citigroup, who are following it daily. First, you will hear Andrzej Bobiński, Managing Director of Polityka Insight, discussing with Candi Wolff, Head of Global Government Affairs at Citigroup, about how politics affects fiscal situation and vice versa, and what is a path forward for internal American policy. In the second part, I will ask Andrew Hollenhorst, Chief U.S. Economist of Citi, how tariffs affect American labor market, investment environment, and monetary policy. In the last part, Johanna Chua, Global Head of Emerging Market Economics, will tell us about international effect of U.S. tariffs, especially on China. So let's hear from Andrzej and Candi.
Candi, in the broadest of strokes, I wanted to kick off and start with a question about the three biggest challenges to the US in the next decade. Basically, what are the biggest issues that politicians should be focusing on? And then probably I'll move on to a question if they are focusing on these challenges.
I think the biggest challenge, and I would say challenges, but really a challenge, is the size of the debt and the deficits in the US, driven by Medicare, Medicaid, the healthcare plans, and Social Security, so the entitlements in the U.S. 2/3 of the U.S. budget is driven by these entitlement programs, and they've been continuing to grow and putting additional pressure on the size of the debt and the deficit. And there's long-term questions about the solvency of Social Security, which is the national pension plan. And there's questions about the solvency of Medicare and Medicaid, but Medicare is providing healthcare to people over age 65. And so, the real issues in the U.S. are in the fundamental fiscal issues and around fiscal sustainability and what kind of trajectory is the U.S. on over the next 10 years.
Okay, I guess this brings us pretty fast to the shutdown that we're experiencing in the States now, because it feels like that's one of the biggest issues about the shutdown now. And it feels like this might be a real conversation about a real problem. My question is, do the two biggest parties, do the two political camps have real divergent views? Are there two real ideas of what to do with this? Or are both sides sort of aware of the problem, but really have ideas of how to address it?
So I think the shutdown, which is a shutdown with both parties sort of fighting over what's the motivation for reopening. The Republicans saying, we'll reopen government if you just pass a clean continuing resolution. And the Democrats saying, we'll reopen, but we want you to address healthcare and the costs of premium subsidies that were provided to certain individuals who are purchasing non-employer provided healthcare. So it's a microcosm of kind of the bigger issue. I think the broader challenge really with the questions between Democrats and Republicans is there's not yet unity that there's a problem with the fiscal status of the United States. There's not consensus that we have an issue with respect to the solvency of Social Security. There's not consensus that we have an issue with respect to Medicare payments and the size of the debt and the entitlement. And so we've seen politicians begin to shift. I think the election of President Trump and the conversation that's been happening around the tax bill when it was getting negotiated, there really was a focus on fiscal issues. And it's since the 1990s, it's really the first time that there's been much more of a political dialogue around the size of debt and the size of deficits, and some politicians saying we got to start thinking about it. But there's not yet consensus. And in my view, there needs to be some additional political crises or some pressure that's going to start to move politicians to actually deal with the hard issues, because there hasn't been a presidential candidate who's been willing to sort of step in and say, we have a problem and we have to address it.
Can you see that happening anytime soon with, the level of political debate with the people who are in places of power today, with, the way social media is framing the debate?
It's hard. Where we may see some of it, and this is where the economics start to come into play, is sometime next year, usually first quarter, there's going to be a lot of U.S. debt that's turning over, and U.S. treasuries have to be purchased. Question's going to be at what price? And, I think if we find that it's getting more expensive because other countries that have to buy it or people who have to buy it are only going to buy the debt at a higher price, then I think you're going to start to see focus by the politicians to say maybe we have a problem. Absent that, I think it's going to take at least another presidential cycle because the real dates for insolvency is in the 2030, 2032. So, in politics in the US, that's a lifetime. So until you get closer to those real dates in a real crisis, then it's hard to sort of drive the politics to get agreement.
And does the fault line of this debate run along party lines? Or can you see sort of within the two parties strong differences on how to address these issues? Because what I'm trying to say is maybe the political system is shaped in a way that it makes it very difficult to get even to the conversation about how to address this.
I would agree that the polarization makes it very difficult. And both parties have said we don't want to touch the third rail, which is either Social Security or healthcare benefits, because that's politically difficult and we want to get reelected. There are some in the Republican Party who have started, and folks that were in the Freedom Caucus that have said, we're concerned about the size of debt, and the way you address it is you make spending cuts. On the Democratic side, those that say, we have concern around the size of debt. How do we address it? You got to raise taxes. The interesting debate that I think needs to play out is, we've been watching the president impose a number of tariffs. The markets are actually looking at tariffs in, and I don't want to say positive way fully, but all of a sudden tariffs are bringing in revenue. So tariffs are just taxes, just another form of a tax, right? So if you're not going to impose a VAT, or the U.S. isn't going to raise individual income taxes, or the U.S. isn't going to raise corporate taxes, then how do you have the revenue to keep the debt amounts down? And how do you deal with these rising costs of entitlements? Well, tariffs become part of that offset. And we're seeing a lot more discussion around, how much revenue is really being brought in, and will it almost one for one sort of address the concerns around the cost of a tax bill or eventually the cost of some of these rising entitlements. And so I think the debate on tariffs is going to start to merge with this question of fiscal responsibility, if you will. And it definitely changes the dynamic. At the same time, the U.S. is going to have to deal with growth, right? Because the way to get out of your deficit and debt concerns is to have growth. And that's how it was addressed in the 1990s when you saw a lot of changes in spending cuts. Get to 2000, had a huge amount of growth, low interest rates, deficits weren't an issue. And then it sort of took off from there. And so it's going to be both a spending reduction and a growth story that I think is going to have to happen.
And do you think this is a debate that's going to basically shape American politics in the next decades? Because again, I have this feeling that we're still fighting the previous war. Looking at politics in very many places, it still feels very sort of 20th century. The parties are 20th century, so the politicians were born.
And the voters are not.
And the voters are not. And the issues are not. And, we've gone through a technological revolution, which is still speeding up. We're going through an energy transition. And it feels that we're on the cusp of a different brand of politics. And what I keep wondering, and what I'm looking for, is the answer to the question, what will shape the debate in the next decade? And it sounds as if this might, but then the question is how? Because I don't think, voters are going to sit there and talk about fiscal growth and taxes, right? So I think this is going to be the core issue. The question is, how does that translate into sort of real-time politics for average Americans and people around the globe?
Probably goes to the question of affordability and how it relates ultimately to a voter's pocketbook and how they feel. I still think politics at its base level is about how a voter reacts to those policies and what they think. And they still want good jobs and have, security. They want affordable homes. And there's certain sort of basic things that I think an American citizen is looking for. And is the government providing it? I think the challenge, as you noted, is things are changing so rapidly that pace of change it's not just the change, because politicians can deal with change. Governments can deal with change. It's the pace of the change, and then it's the fact that the reaction to the change and how people are receiving information is so quick. And there's so much information out there, whether you're getting it in podcast form or we're getting it through other forms of social media or the forms of information that are coming in, it is just really hard to figure out how do politicians sort of communicate. And that's your point around what's the 21st century view of politics. It's a lot more personality politics. It's a lot more of working outside of kind of the mainstream. It's finding different ways and using podcasts, et cetera, to get to voters, because how do voters take in information today? And that's where, politics is really starting to shift, is because it's how do you receive that information and where do you hear it? And a politician's going to have to meet that moment. Now, they also have to think about how they meet the moment with the message. And I agree with you. I think I probably still live in the 20th century. I'm the old school politician, right? Until you go back, and I think we don't know what the 21st century version is going to look like. It's definitely going to be more innovation driven. I think the whole innovation infrastructure and how you start to deal with a bunch of these issues is, where's AI going to take this? I think that's the unknown. Get productivity, efficiency. How is that going to play out? How does it affect people's lives?
Another thing that I think is appearing across the spectrum, across the globe, and this is something that happens over and over again, but I think it's very interesting and salient and very today, is the generational rift, the difference between, and this also brings us to the sort of 20th and 21st century, but this is also about taxes, about spending, about Medicaid, about Medicare, because basically the older parts of society, with people growing older and living longer, will consume lots of the funds that governments will be spending, and these older people in many places will have the votes to basically tax younger people who will have completely divergent different needs. As I said, I think this has happened pretty much everywhere and always, but I feel that this conflict is growing, and I think it's going to basically blow up in the face because the difference in needs is growing and is more salient. So basically my question is, how does that write itself into the system? Because the system is constructed in a different manner. I mean, it goes between, Republicans and Democrats, blue collar, white collar, etc. But I think the fault line is different than the fault lines that shape the system. It's not about left to right. It's about young and old.
I'd probably argue, at least in the last few election cycles, it's been more about educated and non-educated. That doesn't necessarily mean young or old, but I do see the evolution, to your point, of the generational divide, which is going to be old versus young. And I think the youth vote has been turning out at higher percentages, right? President Trump really got a turnout on the youth vote that normally would have been probably more Democrat leaning. And he was able to get a portion of that vote to turn out. It wasn't on fiscal issues. But when you ask pollsters today about what is the makeup of sort of a center, the U.S. is generally viewed as center-right. What is a center-right person? What does it stand for? And a few years back, you would have said economically, lower taxes, smaller government. This is on the Republican side, a little bit more of like the Ronald Reagan Republican, right? And socially liberal. That's not true today. The younger voter is socially more conservative and economically more liberal. There's a willingness to have more government. There's a reason populism has been growing, and I think driven in large part by the fact that in the last 10 years, if you ask the question, do you believe that your children are going to be better off than you? The answer is now no. And it was always yes, yes, yes. And so the whole question of what is the American dream and how do young people think about that American dream and what are the factors that go into their thinking is what's going to create the divide between the over 65 baby boomer generation and retirement who have lived an American dream and seen wealth creation and feel like they can buy their own house and happen to have a bunch of stock, to a younger generation that doesn't feel that it has those same opportunities. Now, some will because there's still going to be a big innovation economy, but I think it's getting sorted out in the Gen Z, maybe millennials, but certainly Gen Zs who've been living through very divisive politics. I have an optimistic view that I think Generation Z will sort of help to figure out how you navigate through the political environment. Okay, I have a bit of a caveat because I got my kids who are sitting in Gen Z, who I'm like, sometimes I'm thinking, are you going to be the next leaders or not? But there is a generation that only knows polarization. and only knows, like, how do you have to live and survive in it? And if you have that mentality of, okay, I still have to figure out how to get things done, then maybe there's an opportunity for a politician to kind of emerge, or politicians to emerge to say, yeah, there are solutions that we can bring forward.
This brings me to the question that I wanted to ask you throughout the conversation. And what I feel is quite obvious to pretty much everyone is that we're living in very unstable times and very uncertain times, which fuel our politics. And for some politicians, it makes it easier to win votes, sometimes even to govern, because basically when people are scared or they're uncertain, then they flock around strong leaders, they rally around the flag, they are willing to put up with things that in normal times, in calmer times, they wouldn't necessarily agree to. My question is, however, how long can we live in these unstable times? How long will we be able to cope with this uncertainty and instability? And my guess is that at some point, there's going to be a strong premium for politicians who will be of a very different brand, who will be calmer, who will promise stability, who will say that it's not always about the fight, it's about compromise. I'm wondering, when will this happen? Maybe this is the Gen Z leaders, maybe it's a generational thing, but I keep wondering about this because I do not believe that this populist wave is here to stay. Would you agree?
I would agree that the populist wave is not here to stay. I mean, I think we all know that there's waves, and we're in a period of that wave. I struggle with the same question, which is, when do you hit the limits? And what do we want to watch for as benchmarks that maybe we're on the downside of the wave rather than maybe still going up? And the problem is that disruption has been occurring, I'd say, at least 12, 13 years. I mean, some would say it was the financial crises coming out of 2008, 2009. COVID hits, and there's been a couple of big books. I'll take it from the right for a minute on the populism and the rise of the right. It's a 100-year war of conservatism. And it's around the fact that if you looked at the Republican Party, it was largely a populist party when it first started out. Then it became much more of a free market, free trade, economically driven, and the party kind of unified because they unified around the Cold War. And then when the Cold War went away, populism rose again, and endless wars kind of bring back that, how much money are we going to spend? Where should the resources be allocated? And those are the debates that I think have led sort of to the unrest and the populism, along with immigration and cultural issues. And so will they get settled, or do people just get frustrated with how much energy does it take for me to be angry and I'm ready for something else? And, I feel like we're probably coming on the downside, but I think it's just intuitive as opposed to, and hopeful, as opposed to anything that's, scientific. But I hear your point. I think there is an end to it. It's hard for me to know sort of what's going to get us there. Is it 10 years from now, or is it, 20 years from now? I don't know.
From my perspective, the Tylenol press conference was a moment when I thought, this is it. Because I strongly believe that the moment politicians go against science in this time and age, their end is near. And probably this can fuel a political debate or a political leader for a year or 2 or 3. But in the long run, I don't really see how you can go against medicine. I don't really see how you can go against science. And I think that especially with the technological revolution, this is something that's going to start the next wave, which I don't know what it's going to be, but this will be my
So
guess.
Your argument would be within the next 3-4 years.
Yeah, the mix of technology and basically problems that stem out of going against science. At some point, I'm an optimist. I believe in people, and I believe that if they get the right data, they're going to understand that. That's not the way to go. But that's just me.
I think we should conclude it there.
Okay, thank you very much, Candi.
Now, we'll dive deeper into EU's economics with Andrea. What is the core of Trumponomics? In your opinion, what is the most important part of economic policy of the current Trump administration? Is it the trade policy, or is it what started as deregulation and is now moving into more institutional dismantling and disarray? Or it is the reindustrialization? What is the most important part? What will stay?
I mean, I think in terms of what's most meaningful for the economy that the administration has focused on, you mentioned the trade policy and the industrial policy, which I would see as very tightly linked. And I think as some of these deals have been coming together, you see those linkages as the tariffs have been coming into effect and being negotiated. You see things like, for instance, the pharmaceutical tariffs that were announced, that companies will not be subject to those tariffs if they build factories in the US. So these are really tightly linked. This kind of reindustrialization of the US, moving manufacturing back to the US, using trade policy to do that. Now, trade policy is also being used for a number of other issues and a number of other priorities. This is also raising revenue. This is also changing incentives regarding where manufacturing takes place. So there are a variety of things that
and sometimes it's nothing from the above, right? Like with the Brazil, for example.
Sometimes for very non-trade related issues, and we saw that in the first Trump administration. Trade policy being used with respect to immigration from Mexico, for instance. So trade policy is used as a tool for a variety of other priorities. But this reindustrialization manufacturing is a key one.
Okay, and I think the most important question that everyone asked back in April when the tariff plan started to unveil was, will it be more pro-inflationary or more anti-growth? This is the biggest dilemma for Fed right now. And by now in September, Fed decided to cut interest rates. So defining this problem, this dilemma, as more about the labor market and economic slowdown than about inflation. Do you agree with Jerome Powell on that? Do you think that the labor market effects are more pronounced and more long-term than the inflationary pressure from the tariffs?
What we've seen from the tariff policy is just that it hasn't had nearly as dramatic an effect on the economy as many forecasters were worried about. And some of that is that the strongest form of the tariffs, the biggest concern around the tariffs were around things like very high tariffs with respect to China, right? Major trading partner, a lot of goods that are sourced maybe only from China. So if those tariff rates became prohibitive, could you get a supply side shock similar to COVID, where you actually are unable to source key inputs into the production process? As it became clear that we weren't getting that type of a shock, that means we're kind of more in a more linear modeling of what those tariffs do to the economy, which would say, yeah, all else equal, you have higher tariff costs that will result in higher prices. And then some firms may pull back on hiring, may pull back on investments because they're paying those higher tariff costs. We have not seen a significant pass-through to consumer prices. We've seen a little bit of firmness in goods prices, but it's very hard to look at the data on individual categories of goods and see something that looks like a very clear tariff pass-through. So it does seem that firms are, for the most part, absorbing these tariffs.
I'm hearing all you're saying, but I'm still waiting for the yet. Maybe we hadn't seen the effects of tariffs on prices yet because of the front loading, because for some time firms are able to squeeze the margins.
Yeah, that's exactly right. The profit margins were quite wide, so it may be that some of this they're able to just absorb. But over time, some of it will probably be passed through. It's always a kind of game theoretic thing where no firm wants to be the first firm to raise prices. So the initial move would be to be cautious about raising prices, to try to assess, is the industry as a whole going to be raising prices? If they are, then you start to see those price rises coming through. So it could be that this is with us for months to come, over a year to come, is all possible that we'd see some of this trickle up through inflation. But those inflationary effects have been very muted so far.
Okay, so the other side of the coin, what is happening on the labor market?
So the labor market, we've had what Chair Powell has called a curious equilibrium, where the firing rate, the layoff rate is very low. So that's good news. You're not likely to lose your job if you have one. But then at the same time, the hiring rate is very low. It's hard to get a job if you don't have one or if you become laid off. And this is really a dynamic that's been going on, before the tariffs, before Trump came into office. So I think it's a key point that we've had this dynamic in the labor market for some time now. We are seeing a further degradation in hiring demand and job growth over the last few months. Some of that could be tariff related. Some of that could be either firms being concerned about uncertainty about tariffs and saying, look, until I know what my tariff rate is, I'm just going to pause hiring. And we've definitely heard that from some firms. Some of that could be more structural, where firms say, I'm going to be paying this higher tariff cost, and that means I need to conserve costs elsewhere. So I'll be hiring at a lower rate due to that. But that slowdown in hiring was already there in the data before the tariffs. So I don't want to attribute all of that to tariffs, but could be exacerbated by tariffs. The pace of job growth has slowed to 29,000 jobs per month. That's a really low pace of job growth for the US. Part of that is probably immigration that's slowed down, and that's meant that the unemployment rate hasn't risen too much. But I would agree with Powell. It's a fragile balance in the labor market.
Yeah, especially the labor market is not unified. Not all migrant jobs being cut because of anti-immigration policy are the same jobs that are being cut by the companies. It's a bit more complicated than that across sectors and across states, right?
Yeah, you have a lot of complicated issues across sectors. You see very different experiences in terms of immigration and unemployment across states.
And you mentioned earlier that tariffs bring revenue, and there's also something we had in the first interview with Candi about the fiscal policy. How much revenue can tariffs really bring? I'm not asking about numbers, because who's got a head for that, but is it significant? Is it meaningful in any way to ease some of the fiscal pressures?
It certainly does help. The tariffs that have been put in place so far, we think are going to raise somewhere between 200 billion and 300 billion a year in revenue.
Could you compare it to whole federal revenue or revenue from some other taxes to just anchor this number?
Yeah, so relative to GDP, that's about 1% of GDP. So if you were going to run a 7% deficit, now you'll run a 6% deficit instead, which is about where the numbers are. But that's the important point, is we are still running 6% plus deficits even with the tariff revenue. So we still have an issue around sustainability of fiscal deficits. These are still quite large fiscal deficits. They would just be even larger if not for the tariff revenue.
Maybe let's move to the industrial policy. Do you think it's really possible to efficiently increase manufacturing in the US as President Trump aims to do? Is it possible to do it, especially with the tariffs? Because maybe you convince some companies to bring some manufacturing closer to home, but they still have to source some materials from abroad, and those are now more expensive, and then you have more expensive labor force. I mean, there is some basic economical logic behind moving production outside of developed countries, right?
Yeah, that's right. When David Ricardo talked about comparative advantage, he was onto something there, and that's part of the reason that we see the trade that we do in the world. Look, I think you'll have a lot more agreement across politicians, Americans in general, economists, the more you talk about bringing high-value production to the U.S., and then a lot less agreement as you move to lower-value production. So kind of at one extreme would be something like semiconductors, where that's a technology that the U.S., for economic and for national security reasons, wants to maintain the ability to manufacture the highest quality, highest technology semiconductors, wants more of that manufacturing to be relocated in the U.S. We had bipartisan legislation that passed to give incentives for this. Now, there are still challenges, which is, do we have the workforce to fill those jobs? You need to make sure that you're training people coming through school to fill those jobs. That's one hurdle for doing that. So there's a lot of agreement. Where there's a lot less agreement is if we think about kind of the other extreme, think about manufacturing shoes or apparel. This is largely done overseas. It's probably not reasonable. Even at very high tariff rates, it may still be more economically efficient to make those goods in areas where there are lower labor costs. So it's probably not realistic or a reasonable policy goal to try to bring every manufacturing job back to the US. And then you mentioned on the supply chain, this kind of goes in between the two, right? If you want to have high value manufacturing in the US, you want to have manufacture of autos and semiconductors. Those involve inputs. It will become very costly to have the entire supply chain located in the US. And that is where
very time consuming, right?
Very time consuming. It could take many years to develop those supply chains. In some cases, the administration has excluded certain raw materials, certain commodities, right? You say, okay, it only exists in another country, right? Then it's kind of unreasonable to put a tariff on that. But I think you may see those kinds of exclusions and carve-outs growing over time as it becomes more apparent where those supply chain bottlenecks could be, why it could be, again, hard to get the high-value manufacturing if you have high tariffs on some of those inputs.
And can you say, where are we with this reindustrialization now? Because the official data, like FDI data, it always appears with a big lag. On the other hand, we have president and the administration boasting about this company, that sector. It's all about pledges, right? And plans to open these many factories, these many jobs, these many cars, etc. And then you have the countrywide pledges in the trade agreements that the EU will invest, Japan will invest, South Korea will invest. But where are we really now? Do you see any movement?
So we're seeing investment related to AI. That's certainly supportive of the economy. But if I look at the jobs numbers on a monthly basis, we're actually losing manufacturing jobs on a monthly basis. So although we've had these investment commitments, although we have industrial policy that's meant to bring manufacturing jobs to the US, you really haven't seen that kick in yet. In aggregate, we're still losing jobs. So you would expect to see that turn around over time if these policies are successful. We're certainly not there yet.
So it's still too early to tell, right?
Too early to tell. I think some of these investment commitments, we still have questions about what exactly the outcome will be. We're still waiting for the Trump administration in China to come to an agreement that could have a manufacturing industrial policy component to that as well, which could be meaningful. So too early to tell.
Yeah, and the China agreement that you mentioned, it's, I think, still very bumpy road ahead of us because every other week we have some new developments, and for now I think that we are more in escalation phase, right, with the Chinese decision to stop the export of technologies essential for raw materials.
Yeah, we have to watch that, yes.
Okay, and then there is the institutional angle, because maybe Dodge is still alive, but maybe not as high profile as it was a couple of months ago. But there's a lot of talks about how independent institutions will stay. We're waiting for the new Supreme Court term to decide on some of that. For now, it seems that Fed is not under threat. But what about other institutions like the Bureau of Labor Statistics? Has anything changed in the way you read weekly data or you read Federal Open Market Committee minutes? For you as an economist, are you concerned about the quality of data, of information that you're getting?
So as an economist, it's highly important that we have reliable economic figures that come out, that we have monetary policy deliberations that are being done in an independent and open way. I think these are two of the innovations that have made economic policy making easier and more effective over the last 50 years, over the last 100 years. So these are kind of, core principles in having effective monetary policy, being able to enact effective fiscal policy, knowing what's going on in the economy. In terms of, how we analyze the data, how we think about the Fed, no, it really hasn't changed. If you think about the Bureau of Labor Statistics, this is an organization that is staffed by thousands of employees. Those employees are doing the hard work of doing things like figuring out the best seasonal adjustment, how to construct the survey. The commissioner of the Bureau of Labor Statistics has to be confirmed by the Senate. So that's a check on the administration. That should help ensure that we get somebody that's able to do that job effectively and competently. The Federal Reserve has even more guardrails, if you think about it that way, in that you have Fed governors who are appointed for a term that extends beyond typically one president's term. You then have regional Fed presidents that are chosen by board of directors of the regional banks, and some of those regional Fed presidents will sit on the FOMC, Federal Open Markets Committee, at any given time. So there's really a lot in just institutional construction of the Fed that would make it very difficult for a sitting administration to, quote unquote, control the Fed. Certainly, we don't think that that's what's going on now, and it's still, mostly the personnel that were there in the previous administration.
Okay, but you probably run all these little scenarios in your head. What is kind of event that will make you feel worried?
I mean, if we had something, and I absolutely don't expect this, but as long as appointments are being made and are following the appropriate process, court decisions are being abided by, then I think the process is working.
Not all court decisions are abided, right?
We haven't seen
in migration, for example.
Well, there are questions about, kind of exactly how things are being implemented. Ultimately, when the Supreme Court decides something, we've never seen an administration, Republican or Democrat, defy what the Supreme Court has said.
Yeah, we've seen in Poland, so that's what I'm asking. Because I know that the line is easy to get it blurred. And in the wider context, this old deregulation policy is now moving from administration to security markets. Will it be pro-growth or to pro-risk and increasing possibility of a next crisis?
Yeah, it's not clear that we're going to get a lot of action, either in terms of the economy or credit creation, out of this round of deregulation. It's always very nuanced and it depends on kind of exactly what ends up changing. But if you look at the major areas, right, one area is deregulation in banking, in financial markets. If you're in an environment where credit is very constrained by the regulation, then that's something that supports the economy. And that also maybe makes you think that, well, we could, build up some risks in the financial sector. That's not really where we are as an economy right now. We're not really being constrained. If you think about the amount of lending that banks are doing, yes, on the margin, is there some bank out there that's not making a loan that could make a loan if you change the regulation? That may be the case. But overall, the supply of credit is sufficient as it is now to satisfy the demand. And then energy policy is another area, deregulation, environmental rules, the idea that that would lower energy prices. We already have fairly low energy prices in the US, low oil price. Yeah, I suppose the one thing that could be interesting is we were talking about AI before. Demands for electricity are going up with the demand for AI going up. So maybe we see more of those pressures. But when you're coming from already low oil prices, deregulation is not going to be as impactful for the economy.
Okay, so the way I hear it is that things are not as bad as we all expected a few months back, maybe. But is it enough that things are not that bad? Is it enough for you to grow in a pace that is, first of all, satisfying for people's aspirations, and second of all, enough to keep the debt and deficit at bay?
Yeah, so debt and deficit, like I was saying, we're running 6% plus deficits and nominal growth. If we have 2% real growth and 3% inflation, that's 5% nominal growth. You're going to be just increasing steadily the debt to GDP ratio. So we really do have an issue there. That ultimately, I think, has to be addressed on the fiscal side. Not clear how that will be and probably won't be in the near term. In terms of the economy overall, though, you can look at the GDP statistics and say, okay, we just grew 3% last year. We're growing 2% this year. These should be fine numbers for the economy. But it goes to exactly what you're asking. Is that sufficient for the American people? If you poll people about the economy, they don't feel great about it. Why don't they feel great about it? I think two reasons. One is there's a big disconnect between those who have above average levels of wealth, who own houses. They're still paying low mortgage rates from before the crisis, who have exposure to equity markets where prices have gone up. So those individuals are feeling pretty good about this economy. Then think about lower wealth individuals who are renting. Their rents have gone up. They don't have the positive effect of higher home prices and higher equity prices. So that's one reason that you're not seeing the survey data reflecting a lot of enthusiasm about this economy. The other thing is going back to the job market. Like I said, if you have a job, you're in your job, things are pretty good for you. But there are a lot of people out there who are looking for a job, or they have children coming out of college who are looking for a job, or they're in industries. Like if you're in the restaurant industry, turnover is very high, right? So you will end up out of a job and looking for a job. So you're getting a kind of bifurcation in the economy where you have some groups that are doing quite well. That's holding up overall GDP growth. But when you start to look under the hood a little bit, it's not an economy that's functioning as well for every American.
And you mentioned AI a couple of times, so I feel that lots of hopes are on the AI and technological progress, broadly speaking. This is the black horse that will carry the economy and allow it to grow even faster than the projections now show, and fast enough to handle all the structural problems, mostly on the fiscal side, right? But isn't it, a bit, it's only one hope, right? It's only one direction. Maybe it should be a bit more diversified.
Yeah, I think it's quite premature to kind of put all of our hopes into AI. I would say it's my hope also. It will be a great thing if we run higher productivity growth for multiple years, and that leads to higher levels of nominal growth, and that makes the deficit easier to sustain. It makes a less inflationary backdrop. It's just a wonderful thing for the economy if you have higher rates of productivity growth. But it's very early days. We're not really seeing that productivity growth yet. Maybe in certain industries, call centers, computer coding and development, these industries are probably already benefiting. At least that's what we hear in anecdotes. But it typically takes years before you realize these productivity increases. And then I would say, if you look at the academic work that's been done on this, the range of estimates for what the productivity boost is going to be are just completely across the spectrum. You have estimates that this will be transformational for the economy. You have other estimates that this will be, very little increase in productivity growth. So I would be more agnostic about that and say, it's a great hope to have, but we can't we can't make plans based on the expectation it's going to happen.
Thank you very much. So we'll just keep hoping, right?
Yeah, let's do that. Thank you.
Thank you. And for the final part of this episode, I will ask Johanna for a more global perspective. Are we already seeing the US tariffs reshaping global value chains? Is there any, hard data yet that confirms that goods are flowing from different destinations, or investors are moving factories to countries with lower trade barriers with the US? I would guess that if we were to see something like this early, that we should look at some very low cost and low skilled goods like clothing, toys, etc. Do you see any real activity?
Sure. I think, in fact, even before Trump 2.0, even under Trump 1.0, when we had the start of a little bit of tariffs, we did already see some shifts on supply chain. Obviously, for some of the low labor-intensive manufactured goods, we certainly saw even China being a bigger source of overseas direct investment in manufacturing, especially going around ASEAN markets. And then obviously going into this administration, there was a lot of anticipation. Remember, Trump was campaigning on 60% tariff on China and 10% of everyone else. There had been some obviously movements, especially around ASEAN markets. But I have to say, this whole reallocation of supply chain did not really materialize as much as we have thought. Because just to give you an example, a lot of people thought that Mexico or India could also be a very popular supply chain alternative, especially with Mexico's nearshoring. And yet, when you look at FDI flows in these countries as kind of an indicator of manufacturing reallocation, we didn't really see a big increase. And it didn't increase as much as you would have thought. And I think obviously there was a lot of competing trends happen. And I just want to say that one thing that complicated this supply chain migration, despite the tariff, is that China was so competitive on manufacturing goods. And especially in the last 4 years during the pandemic, when demand fell so sharply in China after the property market, that it ended, and they had so many supply-friendly policies, that China's deflationary pressure and excess capacity, and even within excess capacity, they kept adding to manufacturing investment. It became harder to relocate supply chain outside of China because China was still adding capacity and being so competitive. So on the one hand, you saw some signs, but it kind of undershot expectation of supply chain. And I think a big driver was because China had so much scale efficiency, and the domestic demand weakness and deflationary pressures caused China to hang on to manufacturing capacity and competitiveness for a lot longer.
And I think that uncertainty is also a big factor here, because from the April Liberation Day until the moment that tariffs were really put in place in summer, a lot of times passed. And I don't think that people even now has this feeling that this is the new normal. Maybe it's not the new normal. Maybe it's just some other transitional period. Maybe something will change in a week or two or a month, right? So for some decisions, you can make some decisions, you can allocate something, but with other bigger decisions, you just wait and see still.
Right. So, I mean, a lot of the supply chain trends I were telling you was more like before, that was more in the recent years. But you're absolutely right. I think this year with so much trade policy uncertainty, that in itself is a deterrent for additional investment. The other thing that I think turned out a little bit of a surprise to people is that the tariff differential of China and the rest of the other markets was not as wide as people thought. Like I said, people thought, 60% tariff and 10% on everyone else. And in the end, India had higher tariffs than China. And then the tariff differential of ASEAN and China was a lot narrower. Not to mention that there's also a threat of a transshipment tariff on Southeast Asian countries of 40%, which then further raises question, well, what is transshipment? How are you going to define that? And that creates another layer of uncertainty. So I think it's a combination of uncertainty, tariff differential being a lot narrower because actually it ends up China has more leverage, thus create significant shifts in incentives, not to mention that we are going through a slowdown period. I mean, in the second half of this year, things are slowing down. So, a lot of CapEx decisions are also cyclical, right? You don't expand CapEx and things are slowing down. So again, that's another factor that's also deterring further capacity expansion.
But do you expect longer-term effects of this trade policy? And especially, what will happen to especially smaller, low-income, export-oriented countries?
Yeah, so I think it's going to be quite challenging. So I think that the challenge that's happened now is not just US becoming very, very aggressive on tariff trade policy, but China itself has also been aggressive on unbalanced industrial policies that is very conducive to maintaining China's manufacturing dominance. And they did not only maintain manufacturing dominance in high-end goods like EVs and autos, but they're also super competitive on like low-end manufacturing goods. And so that's also been a challenge for low-income economies. So the question right now is, do we think that's going to keep happening? Well, one of the big things we're watching very closely is the next fourth plenum in China, where they're going to lay out their next 5-year plan. Because I think we're getting to this juncture where the growth in China is so unbalanced. This cannot be sustainable. And we are making this prediction that at the margin, they're going to shift a little bit more towards consumption support, a little bit more rebalancing. And that could at least help at the margin facilitate some of this low-end manufactured, labor-intensive manufactured goods that China is kind of holding on to, could create more room for that to migrate. Except that I think this process will be very slow because, of course, China still wants to preserve jobs, right? So there might still be resistance. And what China has been doing to retain competitiveness to the deterrence of other countries is they're also automating a lot, right? And they're providing all this industrial upgrading. So again, we think eventually it will move, but it actually ended up a lot slower. But there are some opportunities because I think the tariff differential is, obviously for Central Americas. Let's say if you look at Central America, Mexico, Egypt, Morocco, I mean, these countries have like 10% tariff and then even lower for Mexico. So there you can make an argument, especially when you're catering to the US market, there's a little bit more tariff differential relative to China. So there you can make an argument, maybe there'll be a shift. We thought some of that will go to India, and until we resolve the 50% tariff in India, it's a bit more complicated. Now, if you're in a developing country in Africa, further away, I have to tell you, unless you're close to a major market, it's going to be very, very challenging for Africa.
Before we move outside of Asia, maybe let's stay in China for a moment. How is China navigating this new global landscape? Because especially in these relationships, I don't really see that any new equilibrium has been obtained. And even now, even this week, we had new restrictions on technologies crucial for the rare earth minerals exports. So where do you see the new normal? Where do you see the goal from the Chinese perspective on the relationship with America?
Look, I think China wants to stabilize its economic relationship with America. I think China has realized and recognized that you need leverage. That leverage is really, really useful. I mean, India now has to learn the hard way, right? It's quite tough. And they realize that critical mineral is the choke point that they want. I mean, they just have this news of tightening even more export control, right? Of course, the question is that could even propel even the West to kind of find their own alternative supply chain, whether it's Australia, Canada, US, and the question of how long will that take? So I think China is using that leverage, but China does still need to trade with the rest of the world. I think China has already navigated how to de-risk itself from the US. We've already seen in the last several years, even before the second administration of Trump, China's kind of reliance on US export market has been coming down because they've already built a supply chain network outside of America to indirectly export to US via connector countries. And we're just waiting to see what this transshipment tariff looks like, but by and large, it's working. So I think they will still maintain that. I don't think they're as worried. But of course, they still want to maintain stable relationship. And so I think as we go into this potential Xi-Trump summit, I think they want to maintain this leverage, and we will see what kind of negotiation will happen. I think there's no trust between the two. And so, for example, they're now competing very heavily in AI. I think in that sector, obviously, the vulnerability of China is in the compute, right? They don't have as strong of a compute. And the question is, to what extent can they develop their own indigenous supply chain or kind of, basically compromise that? So we don't know how this whole game is going to evolve, because China is going for a different model of not having to go to the very frontier technology and just doing, diffusion and application, despite not being the most critical cutting edge model. And then they will try to indigenize their supply chain. So I do think that this whole supply side policies for new productive forces, there will still be some sector that are very strategic for them that they will continue to support. Semiconductors is still a strategic industry, and related semiconductor manufacturing equipment. AI is a very strategic sector. But I just think in some sectors, maybe they overdid it already. And like, for example, when it comes to clean tech, solar, wind, a lot of EV, they already dominate. So I think if anything, maybe they kind of overdid it. And we're starting to see potential trade tensions already evolve. So I thought it was quite encouraging that China announced like export licensing restrictions now on the exportation of EVs, which suggests to me that maybe they recognize that just allowing unfettered, price decline and dumping of EVs is going to create a lot of social tension. So they're trying to already calibrate that. And I think they feel more confident about that sector. But so that one, the supply side policy is getting calibrated, but in other sectors, they're still going to push. And I think this is still an evolving. They do want to stabilize U.S. trade relationship, but I don't think you can ever really restore trust. The idea is so far, their export is not suffering. They haven't really lost export market share because they built a network around outside of US. The only question that I have is this year, net exports is contributing 32% of their GDP growth in the first half. And most of that is coming from EU and the global south. And the question is, how sustainable is that? If China
especially with the EU slowing down systemically,
maybe
right?
EU will not be as aggressive or put unilateral tariffs like US, but again, there could also be risk of more trade protectionism. And then, global south, what's the absorption capacity of global south to keep running larger trade deficits? So I think something eventually has to move. And that's why I think we're at a critical juncture where after an extremely unbalanced economic policy over the last 5 years, they have a decision to make now. In the next 5 years, do you need to now start rebalancing a little bit more? Because otherwise, if you just focus again on not supporting domestic demand, your growth rate can
I think the question is not do they need to, but do they know how to? Because it seems that running a very export-oriented policy is easier to really significantly expand the domestic market in a stable manner.
So I think historically, China is very good at managing supply and putting industrial policy to be super competitive in an export. And their success rate on boosting demand, especially consumption, I think they can boost infrastructure because they just set up a plan. But consumption is a different story, right? You're dealing with the psychology of households and they're just hoarding savings. How do you drive up confidence? And it's particularly challenging because you have a property down cycle that's going on, and that's 2/3 of household wealth. And that's going to be a struggle to navigate. So you're right,
and the response is not only money, it's in institutions, right?
Yeah, so look, I think, this is not going to be an overnight success. This is going to take time, right? But they clearly cannot do what they've been doing the last couple of years, which is not doing enough. And I think we're already starting to see signs since late last year that they're now starting to make a policy pivot. And it's a question of whether it's big enough, aggressive enough, that will move the needle of people's psychology. So what we're expecting in this next 5-year plan is, last year, we already have this consumer trade-in program, but that's not sustainable. You just pull forward your durable goods consumption. Once you buy a car, you're not going to buy a car again. So there's this question whether they're going to extend that trade-in program to do more services sector, like go to a restaurant or movies or whatever. But that's not going to be the big driver. That's more just keeping things going, provide a bit of support. But the new thing is that I think seems to be something to watch out for is that since late last year, they started, and China didn't do this before, they started to give a lot more targeted cash subsidies, targeted to low income, for childcare, elderly care, pre-K. These things we didn't see before. I mean, they're not like European standard generous welfare program, but we're getting more and more these targeted programs. And we are expecting that is a sign that they experimented and they see the effects. And we're going to probably see more of that broadening out, maybe larger increase for this next 5-year plan. Now, is that enough? Okay, maybe that's not enough. The other thing that we're also watching is we're also thinking that they're going to have to do something on social safety net. Part of the reason why people keep hoarding savings is there's just not enough pensions. So people do not have enough to save for their retirement. And some of that is going to eventually have to come from central government. And the debate is because in the past they've been very reluctant and maybe they're worried about the fiscal sustainability. But we're now at a juncture where, that sustainability is also about the denominator. Like you cannot have deflation, right? So I think we are expecting there'll be a combination of more targeted cash subsidies, nationwide welfare subsidies, then a reform, a social safety net, especially pension, but maybe medical insurance, unemployment. And that will provide a little bit of us and psychological support that maybe could also allow, in the next 5 years, the savings rate of China is so abnormally high. It never really normalized post-pandemic. So if some of that announcement and over time, especially if tier 1 property prices start stabilizing, tier 1 has more hope rather than the lower tier, maybe the excess savings will kind of normalize. That together provides a little bit more of a consumption support. And then supply will be more selective and you get a little bit more rebalancing. But I have to admit, there's obviously a risk that they will under-deliver and people are very, very skeptical. But I do think compared to what happened in the last 5-year plan, I do think they're going to have to give more this time around.
And you mentioned that China has these leverages in relationship with the US and other countries, and India doesn't. How will India find its new place in this?
Look, I think India, obviously India is still negotiating with the US. So this whole 25 plus 25, I think there is still room for that. I'm hoping that, even like, Trump and Modi, they seem to be saying nice words now to each other. So let's see what happens. I think there's still enough people in Washington that recognize that if you really need to provide a bit of a counter to China, this is a large, dynamic democracy.
You cannot antagonize India, right?
Of course, maybe something happened there. So I think let's see what happens on the tariff. For now, obviously, it's had a hit on India. And they're now trying to cushion a little bit of that hit by providing a bit of fiscal support. So we had an income tax cut earlier this year. And then they just announced implemented in September, this GST cut, which is a small, targeted tax cut policy to kind of buffer demand a little bit. And it's possible we might even see more monetary easing. That's something to watch out for. But yeah, absent that, then India's growth will slow down. But the good thing is India is a more domestic-driven economy. Of course, the tariff has an impact, but it's not as damaging as, say, if it were Vietnam or Thailand. So it's slowing down, and then you have a little bit of policy support. So I think they're buying time, and I think we're still hoping for some renegotiation. And I think although there's obviously been, again, high profile, that whole Tianjin Shanghai Cooperation Summit, you see that, Modi with Putin and Xi, very powerful images. But I think part of that really is a bit of a political posturing to show that we have options. But in reality, I think India needs the West. India's trade relationship in China is very lopsided. They basically import from China, just like most countries. For India to develop a manufacturing base, not only for the domestic market, but to export, they need other markets. And obviously EU is one market and US is another market they still need to grapple with. So I'm hoping that there will be some diplomatic, hopefully, de-escalation and things could eventually provide a bit of avenue for negotiation.
Yeah, but the whole Trump trade war released this political dynamic in lots of places that if the US is no longer there, if we cannot trust them the way we did. In Europe, it's obviously not only trade, but mostly geopolitical. But in other countries, it's more about economy. Then maybe we should look for another partners. Maybe we should sit at different tables with different people and talk. And for example, EU has managed to make a big push on the trade deal with Mercosur. So do you see these relationships, of course, not replacing completely the US because US is too big, but maybe adding a bit more balance
I think
worthwhile?
I think what is very remarkable about this trade war, quote unquote, versus like the last time we had this amount of tariff in the US in the 1930s is in the 1930s, 24 countries retaliated on the US and you had a global trade war and global trade collapsed. I think the fact that this time around is really interesting, right? You basically had Trump just unilaterally imposing tariff, and aside from China, nobody really fought back, which I think tells you there is this recognition.
Canada a bit maybe.
Well, very marginal, kind of targeted, but there is this recognition, right, that we have a lot at stake here. There is still this desire to preserve the global trading system. Of course, it's suboptimal without the US there, and that does create a lot of friction, but obviously there is still this desire to create more trade avenues. And, actually, ironically, from China's perspective, it does give them a lot more leverage. So maybe one of my worry about my rebalancing thesis of China is I just slightly worry that, right now China is getting away with still squeezing more net export growth driven model. And right now, it's very tough for economies to really retaliate on China because you're already dealing with the US. And like I said, look at India. Now in a way, China has gained leverage. So in a way, from China's position, the way US has behaved has kind of given China a little bit more trade leverage. But I'm still thinking, despite that leverage, I don't know. China also has a lot to gain by maintaining international kind of trading system because that's been a big driver of their prosperity, which is why I think they are doing these anti-involution, why they're putting these export licenses of EVs, because they also recognize this is not sustainable too. So yes, look, I think countries will try to look for other alternatives, buy some time, maybe do a little bit of domestic reforms. But unfortunately, not everyone is going to have a lot of capacity to offset this shock, right? And I think the struggle here is that if you're a small open economy that is not close to a major market, so, let's say Africa, right? So the scope for manufacturing-led development, productivity from globalization and supply chain and manufacturing-led development was already challenging with China there. And then you have more trade shock out of US that is creating even more challenges. And so I think it is going to be a challenge for emerging market that if you don't have the pathway for manufacturing-led development, and we haven't quite figured out what a service-led development model really looks like. Of course, we have some experience like Poland has developed, and we have India. But, the question is, do you have the skills? And we have AI. So we don't even know how that whole thing is going to evolve. So it is going to be a challenge for some countries.
Yeah, and what's the landscape in South America right now? Because here it's not only the economic logic, it's also very much political with the US, and it's even seen in the rate of tariffs. Like Brazil has very high tariffs because there is, well, to put it mildly, not much good chemistry between presidents, right? And Argentina is being slightly supported by the US. What the Trumponomics mean for South America?
Yeah, look, I think South America is interesting actually. In essence, with the exception of Brazil, everyone's tariff is quite low, around 10%, right? And then actually Mexico, you would have argued based on the auto tariff, steel and aluminum, and exemptions, and then the fentanyl tariff, and then USMCA exemption. We were estimating the effective tariff rate on Mexico should be roughly about 9%. But when we look at the actual data and what tariff is collected, we end up calculating that actually the effective tariff rate on Mexico is only 4%. So from a tariff perspective, they're in a good space. Of course, the struggle is that, US is slowing down and Mexico is already slowing down because they have other kind of issues as well. But overall, Latin America's growth has actually ended up relatively resilient in the first half of this year. And part of it is, again, except for Mexico, most of Latin America is not as kind of directly trade exposed to the US. And like I said, you have some buffer of Central America having relatively more benign tariffs. And of course, people are looking at what's the impact of the migration curbs. And so far, we haven't had a dramatic impact yet on the domestic market. So again, Latin America so far has held up relatively well. And then there's hope that maybe in the future, from the competitiveness standpoint, there's scope for Central America, like Costa Rica, Dominican Republic, Honduras, that can have some tariff, for certain low-end manufacturing they can develop. Brazil is interesting, though. Although you have a high tariff on Brazil, I would argue that Brazil actually had a lot of exemptions. So Brazil actually runs a trade deficit with the US. So even though there's a 50% tariff, they had more exemptions than India. And Brazil actually is a pretty closed economy and they export a lot of commodities. So if you can't export, you can always reroute commodities much easier than what India had to struggle with. So actually, this whole tariff didn't have much impact on Brazil's economy. The interesting thing that we're watching in Latin America is that we seem to have, in the past, US foreign policy was generally indifferent to Western Hemisphere. They didn't really pay attention to South America, right? It was always like Middle East, Asia, China. But this time around, we're waiting for the national security strategy of Trump administration. There's been a lot of talk that is US now going to focus a lot more on homeland security and Western Hemisphere and stuff that he's doing in Venezuela and immigration. So the thing to watch out for in Latin America is politically, are we going to move to potentially a more interventionist policy from Washington to South America? That's a question. We saw a little bit of taste of that by what Trump had done with the judges in the Bolsonaro case, right? So that's something to watch out for. And then if he likes you, then you've got the Milei kind of the bailout case on Argentina, although we don't have a lot of details yet. So that tells you there's a little bit more interference. But, look, on a macroeconomic standpoint, the issue with South Latin America is that when you go to Mexico, Central America, they trade a lot more with US. But once you go down south, once you go to Chile, Peru, Brazil, Argentina, they actually trade a lot more with China. And so Latin America is kind of bifurcated in terms of geopolitical influence. And of course, the best avenue for countries that hopefully you can just trade with both. And we will see to what extent. I think US is already putting pressure. There's been a lot of news that Mexico is under pressure to put tariff and investment restrictions on China. But I think Mexico has no choice because US is their major trading partner. But I think for the others, people want optionality. I mean, Lula, Brazil wants optionality, and we will see what happens going forward. And the other big thing to watch out for in Latin America is because we have a bunch of elections next year, and there's a debate to what extent, governments will swing more to the center right, which the market will perceive as more positive. The interesting thing is Brazil. People used to think maybe Brazil might move to the center right, but because of the tariffs threats that come out of the US, it actually seems to have backfired for Trump, and Lula's popularity has gone up. So now actually Lula might actually get reelected again next year. So I think these things are still relatively fluid.
And in the long term, do you think that what we're having now with increasing trade barriers, not only in the US, but also in the form of kind of climate policies in the EU, and the big economies concentrating more about their internal markets and protecting jobs internally, all these talks about nearshoring, friendshoring, do you think that this is a new trend that will eventually lead all these small, open, developing economies, simply with nowhere to go? Or will the customers in these richer economies, after a couple of years, say, okay, that's great, but we want our cheap goods?
Yeah, no, it's a very good question. Look, I think this whole rising protectionism was a trend that, was happening over the last couple of years. But like I said, the good thing is there was not universal retaliation. So again, although you are seeing some tariff protectionism, let's say in EU, it's not like unilateral, universal. It's more targeted. There's certain kind of parameters and rules around it. So I think that at least provides a little bit of support. And meanwhile, again, maybe to some extent, this is more diplomacy rather than having, to what extent has big impact. But you did see, for example, China put zero tariff on almost all African countries it has diplomatic relationships with. And then during the UN General Assembly, I think Xi Jinping announced that I think China was no longer going to claim developing country status for kind of new kind of trade agreements. So again, China is diplomatically, symbolically trying to give, again, mixed messages, because obviously China also is not that easy to negotiate with, but they seem to be kind of giving some mixed messages of trying to preserve a trading regime system. But we will see. I think that's why we have to guard very closely against it. I think there's still a lot of people that recognize that trade is still very, very important. But I think for some of these emerging market countries that are struggling because they're not getting enough job creation for manufacturing, and like I said, even services could also be a struggle if we have AI. It's going to push some countries, like we see this, for example, in Indonesia, to have to do more populist measures. Because when you have social kind of economic struggles and it creates social anxiety and discontent for some of these democracies, the only way you kind of mitigate that and you appease that is then you have to provide a little bit more activist fiscal policy. Of course, the struggle there is not every country has the fiscal space to do that, especially post-pandemic. So it is going to be a challenge. And so what we really need is we need countries to push reforms and open up their economies. You have to work even harder to kind of make yourself more attractive place to do business. But of course, the struggle is if you're a small country, it's harder to attract capital. So either you need to talk about creating more integration. So I'll give you an example. There was this Singapore, Malaysia. They created this economic zone earlier this year to create more synergies and efficiencies through creating more common integration. So again, the question is, that's going to be what small countries are going to have to do. First of all, you're going to have to try to figure out a way to integrate more. You try not to choose. You try to open up to trade on both sides as much as you can. You try to find your niche. But again, it's not going to be easy. The whole thesis of, emerging market, per capita income convergence to the rich is just a foregone conclusion. If you're poor, you're going to get richer. The easy wins of productivity gains from globalization is not there anymore. It's much harder. So it's going to be a challenge. And so that's why when you look at globally emerging market, you have to go country by country. It's not like all tides lift all boats anymore. There'll be winners, there'll be relative losers.
It's definitely a lot of interesting things to look ahead. Thank you very much.
Thank you.
That's all for today. This was a special episode of Value Added created with Citi Handlowy. Thanks for listening.